And here we go. All right, so I think everybody that's here, we got a handful of folks. I know we got many more that are registered. So we've just hit the record button. So certainly thank you for joining us live. And thank you for those who are going to join us on the recording a little bit later. So I want to spend the next, hopefully under 90 minutes. I don't want to bore you. Kind of going over at least my observations and my take as to what it's like in terms of how do you afford the dentist life. And there's so many ways that this can look like. And so, again, first time we're giving this lecture. This is the fifth in a series on well-being and personal finance for early career dentists, targeted to residents, students, and also colleagues early, that are early in their career. Although I think there's a lot of information here for folks that are later in their career. And I think these are all just good information to review and to be reminded of. And so this was to be the fifth and final lecture. However, we do have a bonus session coming up. Everybody remember Ed Combs from session 2. He actually put me with a certified financial planner that is a fiduciary and that is fee only and exclusively works primarily with dentists. And so you're hearing me from the standpoint of a dentist giving you personal finance advice, but want to get a professional in here. And I think she'll cover some of the topics from the standpoint of being a fiduciary, also the things that the things that she likes to focus on, dentist specific, and also planning, having a practice into all of your future financial planning, which is not something that I'm really going to speak a lot about. Number one, because I'm not really an expert in it, having never bought a practice, being more of a W-2 employee the whole time. But the other part is, just how does that work in terms of, your asset and your net worth and for tax planning strategies. So Sharon Weaver, she's based out of, I believe, in Kansas. I could be wrong, correct me. But we look forward to having her around probably early of next month, and that should round up the series before we take a break in the summer. So again, I'm going to give you my disclosure. So I am not a financial advisor, accountant, tax lawyer, finance professional, counselor, psychologist, or therapist. Like I said in the first one, I'm a dentist just like you who's done some things, made some mistakes. I'm a program director. And so I have no financial interest in the items mentioned in this presentation. So I may mention some services and products, but I am not compensated. It would be nice if I was, but I'm not compensated for plugging any of these things. And so I also want to say these are my opinions and insights based on my personal experience, and so it does not constitute professional advice. So I'm here to kind of give you my opinion, my thoughts on, you feel free to dissect it, cross-reference it, question it, and come back to me if you see anything that either doesn't make sense or maybe you find something that's, contradicts what you found out there. And so this information is for education and entertainment purposes only. So, and I'd emphasize education. So hopefully some entertainment there. So I kind of want to reiterate some of the topics that that I covered in my first lecture back in January. And I think in the end, our most valuable asset really is time. Time is more valuable than money. And so you can get more money, but you can't get more time back. So just like the last time, I wanted to kind of quantify what the value of your working time was. And so if you remember from the lecture in January, if you were to take an average general dentist salary of $180,000 and you were to figure out what the post-tax take-home pay is, and then divide it by the average working time for a dentist, it roughly works out to about $1 a minute. And so you can kind of think about anything that you buy, whether it's your daily purchases or something big that you're going to be paying off for a long period of time, and quantify it to the amount of time you're actually going to have to be at work. And I think when you think about things that way, it really makes a big difference. And then, of course, I had to kind of throw in what the oromaxillofacial surgeon makes. Now, they work a little bit, they work more hours than we do, so I kind of factor that in. Their take-home pay after taxes based on a $400,000 salary after taxes gives you $23,000 monthly. They work more hours, so roughly works out to about $2 a minute take-home pay. Another concept is we wanted to look at what your income minus your expenses gives you your net income. And that's really what keeps you afloat. And it's all about the cash flow. And so this is a concept that I went through back in January. Cash flow is the lifeblood of any individual and any business. So you may have a good net worth, which I'm not going to talk about here, but if that net worth is tied up in illiquid assets and for some reason your liabilities and expenses exceed what's coming in and you're not able to service it, that's when things can run amok. So it's all about the cash flow. So this is Jimmy Turner. He's the physician philosopher. He's got a lot, he does a great course. He offered the course for free, actually, about personal finance. He's actually a colleague, now a colleague. He's an anesthesiologist, academic anesthesiologist based out of Wake Forest, which I guess we are officially a part of. He's got a great blog. Early on, it's really his focus was on personal finance for residents from a physician standpoint. So I draw from a lot of his material, and he's got a great website. He does kind of combine the same themes. I'm kind of mimicking what he's doing and kind of tailoring it to you. Well-being and personal finance. And it's all about freedom, working on your own terms. And so this particular article, he is called Lifestyle Inflation After the First Big Paycheck. And so many of you are making a resident salary. You're about to go into an attending salary or a private practice salary, which is going to be significantly larger than what you're earning right now. And so the highlights of this particular article are the following. He says, use a backwards budget to determine the rate of savings you required to retire by the age that you want. Then reverse engineer it and build a lifestyle with what is left over. And so the take-home message here is that you want to pay your future self first and your current self last. And I know that we've worked really hard and you get that big paycheck and we want to enjoy life. And so you want to be able to have that balance of figuring out what you need in the future. But here's the other thing. If we take on an expense, for instance, if we take on debt, well, whenever you're doing that, you're actually doing that at the expense of your time with your future self. So pay your future self first and your current self last was his take-home message. So let's look at a cash flow scenario of an example cash flow scenario of, again, a dentist making the average salary. In this case, $180,000, the published one. So if your annual salary is about $180,000, you're going to pay about $31,550 in taxes. You're at the 24% marginal tax rate as of 2019, which were recently updated, by the Trump administration. Now, depending on where you live, your state taxes are going to vary. So in North Carolina, it's a flat tax of 5.25%, which you're going to pay about $9,450. If you live in a high tax state like California, it's considerably higher, almost 10%. So California, which is why a lot of wealthy people are actually moving from California to some of these no tax states like Florida, Nevada, South Dakota, Texas, I think Washington State, I believe Tennessee also. South Carolina has a little bit of a higher tax rate. Income tax rates $10,000 from that $180,000 salary. Now, if you're like me and you're employed, you're paid by you're earning a W-2 income, which most dentists aren't. You would be paying other Social Security, Medicare taxes, which would be a deduction of $13,770. If you're self-employed, 1099, contractor, which is probably most dentists in private practice are, it's actually higher. And so, it's actually a little bit more, 21,700. So after all of the taxes and deductions, you're left with about 117,300, which works out to monthly take-home pay of, just shy of $10,000. So let's look at what the typical expenses of somebody could be. And this is just hypothetical. So if you're somebody with the average student loan of $300,000 and you're paying it a 25-year term, and it's about $2,300 a month. Let's say you bought a home and you've got a $300,000 mortgage at 3.5%. It's about a $1,350 mortgage. On top of that, other expenses associated with living in the home, property tax, home insurance, utilities, home maintenance, and then probably other things, cable, internet, cell phone, health insurance. You definitely need health insurance. So kind of looked up some rates, $650 for a married couple. I'm going to use malpractice insurance and disability insurance. We talked about the importance of having these things at my first lecture as part of your foundation. You're left with $4,170 a month. Now, I didn't even talk about any savings. I didn't even talk about any retirement savings yet. So let's talk about two different doctors. Let's talk about Dr. A. He's a little bit more frugal. Let's call him Dr. Frugal, for instance. So let's say he's still got the car that he had when he was a dental student, he or she. So he's got no car loans. He or she's probably got some credit card balance from being a student and a resident. So, however, is committed to paying it down. So let's say it's $700 a month. Car expenses, insurance and gas, food, $300. They like to shop at regular grocery stores, Aldi. I know Dr. Riggert likes that one. Still some allowance for fun, eating out, entertainment, trips and travel, shopping, clothes, gadgets, toys. They're left with about $1,720 a month. I think that's probably a comfortable lifestyle. Now let's look at Dr. B, who goes through lifestyle creep. They decided instead of getting the $300,000 mortgage, they got the $500,000 mortgage. And so they're spending about $825 extra with a bigger house. There's more property tax. There's more expenses. They're paying their credit card debts less aggressively. So instead of $700 a month, it's $300 a month. They've decided to get the doctor car. So, I just threw out there $55,000 car loan, 3.5% for 5 years, $990 car payments with associated expenses, which are probably a little bit higher than you are with that Honda Accord. A little bit more in food, maybe Whole Foods instead of Aldi. Eating out and entertainment, going to the clubs. That's what I have pictured here. Trips and travel, a little bit more extravagant, and figured, you've worked so hard. And then shopping, buying gadgets, toys, clothes, whatever. What do you think this person has left over? They're actually at a negative $1,845. This is even despite not putting any money for savings, not putting any money aside for retirement. So that's an example of lifestyle creep. So I showed you this concept in the first lecture where we got the high income earners losing loop. It's very easy to have expenses, accumulate liabilities that far exceed your income. And if you don't keep track, it's very easy to do that. So what's one scenario? What about if we increase the amount that you make? Well, I think it's also very easy to fall into this losing loop also. Here's how we'll demonstrate it. An oral surgeon, $400,000, they're at the 32% marginal tax bracket. So they're paying $90,000 in taxes. Again, you subtract the state tax. Now, for the purposes of my demonstration here, I'm using somebody that's based in North Carolina. But you could see, if you live in California, it's significantly more. You live in Florida, it's significantly less. W-2, they're paying about $30,000, and they actually work out a little bit better being self-employed at that higher tax rate or that higher income level, paying less taxes than somebody who's a W-2 employee. So they're netting $260,000 a year. That's pretty good. That's pretty darn good. You know, about $21,000 monthly. So let's plug in those same numbers again. Actually, what I did was I said, let's assume a higher student loan because they had to go to residency a little bit longer. And so therefore they've accumulated more debt. And so therefore higher payments, $2,900 paying off their student loan, $500,000 mortgage. You know, they're making more. So let's give them maybe a nicer house. You know, I said $300,000 for the dentist, $500,000 for the oral surgeon. So $202,000, home insurance, a little bit more, property tax, a little bit more, utilities more, home maintenance more. Again, the usual things. So they're left with still a pretty good clip, $14,190 monthly. However, let's say you've got a family to support. How can you blow that very quickly? I think it's very easy to blow that very quickly. So instead of getting the $500,000 mortgage, they decide to get the $1 million mortgage. And by the way, especially in today's housing market, which I'm going to talk a little bit about, if you're in a major market or even a secondary market like Charlotte, you know, I saw like a $3,000 square foot house on the market for $1 million in an area that's very close to where we practice. So you know, if you have got the bigger house, your utilities and your property tax maintenance is higher, your credit card debts are higher. They decide, you know, again, I use that Mercedes GL just because I used to own one of these. It's quite a pricey car. It's a very nice car. Your car loan's about $1,350. You got 2 kids that you're putting through private school. You got kids' activities, you know, whatever it is, karate, jujitsu, piano lessons, dance lessons, band camp, summer camp, all that stuff. Car expenses, food, eating out, entertainment. You know, that food budget actually seems kind of low. I feel like I'm blowing that with my family of 5 almost on a weekly basis. It feels like that. I don't know if that's the reality. Trips and travel, you know, they got to take that one trip to Europe every year, you know, when we're in a non-COVID time. And then there's the shopping, you know, you got to go to get your nice stuff. And so this person, you know, is pretty much working out a negative cash flow, even though they've got to take home of $14,190 after their major expenses. So it's very easy to go through lifestyle creep and blow that. I'm going to show you a little video that it's from Naval. Naval is actually an entrepreneur that made a fortune, I think, through angel investing. He actually founded the company, Angel Investor. He's got a very nice tweet storm that went viral, that turned into a podcast about how to be rich. And it's not just from monetary richness, although there's a lot of principles there, but it also talks about being happy. So I'm going to play this video and just to kind of illustrate this fact when he was interviewed by Joe Rogan on his podcast.
I think people have to be very careful to not get trapped along the way with things that you can afford with your current lifestyle, but they're also imprisoning you in the fact that you are now going to have to work this 40-hour-a-week job. Working for things as rewards is a real trap.
It's the biggest one. There are 2 great addictions, heroin and a monthly salary. Right? And that's why you can't get rich renting out your time. Because even when you start charging more and more for your time, it's a slow upgrade loop. You upgrade your house at the same time, you upgrade your car at the same time, you move in the neighborhood. Even lawyers and doctors who are charging $300, $400, $500 an hour, they're not getting rich because their lifestyle is slowly ramping up along with their income, and they're not saving enough. So the first thing you have to do is you have to own a piece of business. You need to have equity, either as an owner, an investor, shareholder, or a brand that you're building that accrues to you to gain your financial freedom.
So notice how he highlighted, let me see if I can get over there. Notice how he highlighted high income earners just like us. And so you want to become an owner, whether it's building assets, whether it's an investment, whether it's a practice. So that's what we're going to talk about going forward. So this was taken from a financial website, financial planner that's targeted for dentists. So I thought it was just a really nice illustration here. So everybody hates the word budgeting. Budgeting is just, it's an awful word. You just want to kind of avoid it. So I'm just going to kind of throw out that word and call this the cash flow plan. And I'm just going to kind of throw up some ideas that are pretty simple that you can kind of employ. And so the first one is the 60-20-10-10 rule. And it's variation. I know it's been published out there, NerdWallet, some other financial bloggers, but it's a good starting point. You start with 60% fixed costs. 60% of your take-home pay should be in fixed costs. 20% of these should be your investments, whether it's building into assets or wealth building, putting it into your business, your practice. So you can make an argument that debt pay down like student loans can fall into that category. Although I think if you're really more disciplined, you can really throw the student loans into the 60% bucket. 10% being short-term savings, being emergency savings, saving up for a trip, a purchase, or something, something that you're going to need it for. And then 10% guilt-free spending. And I think if you follow that, plus or minus 10% each category, depending on where you're at or what your income level is, generally just setting that, you can do pretty well. And so I kind of took this one from Ramit Sethi, who wrote the book, I Will Teach You to Be Rich, and, kind of taken this 60%, 60-20-10-10 rule and modifying it, early career versus mid-career. So fixed costs, early career, 50 to 60%. Once you've established, maybe making more later on, your expenses and your fixed costs would go lower. And then maybe you can ramp up your investments in your wealth building, 20 to 25%. Early career, when your income is a little bit lower, maybe your spending is a little bit higher, 20 to 35%. And then your savings goals are a little bit lower. So perhaps, let's kind of apply this to a general dentist. If I were to take, again, the $180,000 salary, it would look something like this, using strictly the 60-20-10-10 rule. Something like $6,000 for your fixed costs. So rent or mortgage, utilities, debt, insurance, car payments, things like that. And then your investing should be maybe around just shy of $2,000. Savings goals for short term, $978. And then you can, whatever's left over, you can do it whatever the heck you want and enjoy yourself. So now that I think the question that and then let's kind of take this again using an oral surgeon. What I decided to do was kind of lower the fixed costs, assuming that the oral surgeon did not proportionately increase their fixed costs. Remember what we said the three major fixed costs are: usually your car, your house, and your debt, like your student loans, allocated a little bit more into investing in wealth building, plus, and then their savings goals, a little bit more, and then guilt-free spending. They can do whatever the heck they want for $2,000 a month. Just an example. So what I put together was an Excel spreadsheet, and this kind of demonstrates one of the sheets here. And if anybody here wants this, just type your name and email in the chat, and I will email it to you. Basically, remember how I said the three major expenses are your car, your house, and your student debt pay down. And so anything in orange, you can kind of plug in the numbers. I also kind of plugged in, what's your annual gross salary? What would be your, what's the state income tax that you're in? And then also a calculator for retirement. So, just if anybody's interested in this, just let me know in the chat or email me afterwards. The second sheet in that tool that I put was a more detailed calendar in which we use the 60-20-10-10 rule. You put your annual gross salary, estimated net annual salary. Now, this isn't exact because it really doesn't take into factors the marginal tax rates. So I kind of just really took a kind of an average, and then you can plug in your state tax rate, and then your 401k contributions, which actually reduce your gross salary and your taxable income, and then kind of plugged it into your 60-20-10-10 rule, and kind of shows you exactly, whether you're on track it kind of shows you right here what your percentage of take-home pay is on your fixed expenses. So whether you're under or whether you're over, and then what are your variable expenses. So, and then also your inflows over here. So again, anybody that wants this, just let me know. I'll send it to you. So the question then we get inevitably is, do I pay down debts or do I save and invest? And so I think this pertains to not the 60% fixed costs and not the 10% fund money, but probably the rest. How do you distribute that? So I'll kind of go through different scenarios here. So let's again talk about debt. Again, the physician philosopher, Dr. Turner, says every borrowed dollar you spend will cost you $1.50 to $2 to pay off later, whether it's your mortgage, credit card, car loan, student debt. If you're borrowing $300,000, expect to pay $600,000 in your lifetime. Now divide that $600,000 by your number of minutes that you got to work. And so again, the question is, do we pay down debt or do we invest and try to build up our assets, to build up our wealth, like what Naval was saying? And so the first question, let's look at credit card loans. And so I was talking to somebody who had a lot of money in the bank, but they carried a credit card loan. And it was nice to see the money sitting in the bank. But it's probably not a good idea to do so, because the average interest rate on a credit card, let's say the US average credit card debt's $5,000, average interest rate's about 20%. Let's say you do the minimum payments, so let's say $100. Over the lifetime of that, you're gonna spend about $13,816 over 12 years. Now, this is an extreme example. This is without even putting more balance on the credit card. It's just making the minimum payments. But what I'm trying to do is it's an extreme. It's just try to illustrate how much you're going to spend in interest payments. So $8,485 in interest over 12 years. Now, I know most of you are going to be in a situation where that's not going to be the case for you. So let's look at another scenario. So let's look at somebody who's, I think the average resident's around 27 years old, maybe a little bit, plus or minus a year or two. They've got a $300,000 student loan, which works out to about $2,300 per month for 25 years. But they want to contribute $2,000 in monthly contributions to a retirement account. So let's look at the two scenarios. Let's look at the doctor hybrid person who's going to put some money paying down debt and they're going to do the $2,300 a month and do $2,000 a month starting at age 27. And so it will take them over 25 years, they will have paid $690,000. Now, if they've contributed $2,000 a month into a retirement account, assuming a 5% annual return, for the first 25 years, and then once they've paid down their loan, the remaining 13 years, they paid $4,300 a month, they will have accumulated $3.2 million at age 65. So what about the person who decides to pay their debt down first, do not contribute into their retirement account? So let's say in their student loan, they've spent about $400,000, paid it off in about 7 years, 9 months. So if they've taken, instead of, paying $4,300 a month from their student loan, and then afterwards, soon after that 7 years, 9 months, they decided to go spend put that $4,300 a month, for the following time. And it actually works out a little bit more, $3.6 million at age 65. So it's kind of a wash. So here's one guideline that I actually took straight from Ryan Inman. It's a great book, nice and simple to read, called Financial Residency, Create Your Own Financial Plan. And this is kind of the guideline. Now, this is to use that middle, anything that's not in the 60% fixed cost and not in the 10% fund money, how you would sequence it. It's kind of the waterfall technique. So number one, contribute to your 401k or 403b up to the match your employer provides. I'm going to talk a little bit more about that. This is free money that you're going to get from your employer. Pay off any high interest debt. So like your credit cards. Create an emergency savings fund up until 1 month of current expenses. Then contribute, if you have one, to your health savings account, which, the maximum for a single person's contribution is $3,500. For a married person, it's $7,100. Max out your Roth IRA if eligible. Next, and I'll talk about why he recommends this. Max out the remainder of your 401k. Utilize backdoor Roth contributions if you're not eligible for a Roth IRA. I'm going to talk about what a backdoor Roth IRA is. Fill up your emergency savings to have 3 months of total expenses at minimum. 6 is probably better. A year is even best. And then pay down any debt that's between 5 to 8% interest rate. Put additional savings into a taxable investment account. And then lastly, pay down any debt with an interest rate less than 5%. So that's usually your mortgage and your student loans. So, so this kind of is a hybrid of which debts you would prioritize and which savings you would prioritize in which particular order. This is just one framework that Ryan Inman suggests. All right, next subject. Should I buy a house or should I rent? And so I'm actually going to kind of go through a scenario with that, because I know a number of you, especially our own residents, I think a number of you have already committed to buying houses. And so let's do the math on this. So I think, you know, as a student, as a resident, we live in apartments, we're renting, kind of want to upgrade, want to live the American dream, get that starter home. Home ownership is touted as the American dream and wealth building. And then you go from your starter home and then you start having a family, you get to a bigger house in the suburbs. And then when you really make the big bucks, let's get the $1 million home. Now, I just spoke to one of my best friends. He just sold his house and bought a $2 million home in Canada. So he's kind of in one of these, he's kind of at this stage right now. So I'm going to do a poll. Let's get some audience participation here. So this is not totally passive. I'm going to launch the poll. Let's give it. My question is, what is the current status of your housing situation? And so let's take the next few minutes to answer this. Just kind of want to see where everybody is. It's pretty even, isn't it? We got 5 more of you. Either you're just playing in the background. That's changing, it's moving. Okay. One more person. Okay. So let's end the polling. So I am renting, have no plans to buy soon. About 1/3 of you, I'm renting but plan to buy within 3 years. Another 1/3 of you, I'm renting but plan to buy within the year. 20%. So it's pretty even. So, all right. By the way, this is my first time using the polling feature in Zoom. So, so pardon my delay here. Let's do the math. So what I did was I went on Zillow, and now this was a few months ago, and this, you know, I looked up this house, which is actually not too far from where I live, and they were asking at the time for $2,200 a month. Now, the biggest argument I hear all the time is, well, if I'm going to rent and I found out that my mortgage is the same amount as my rent, what's the point in me throwing money in the garbage when I can actually build equity in my mortgage? So let's use this particular house as an example. So you're renting for $2,200 a month. You're paying renter's insurance. You're paying utilities, cable, and internet. So in total, it's about $2,750 a month. So what about if you buy? So originally, I underwrote this at about $400,000, although I think the market these days has brought it up to about 450,000, just the hot market that we're in right now. And so let's say they did a conventional 20% down, and so they've got a $360,000 mortgage for 30 years. Now, I used 4% as the interest rate. Yes, it's a little bit higher than what you can get, but probably it's a little bit closer to what, you know, historically has been the norm. So $1,718 mortgage. So yeah, it's definitely less than your $2,200 in rent. And that's usually where people stop. Let's take the numbers further. You got to pay for home insurance. And so home insurance, let's say in this case, is about $1,800 annually. You got to pay for property tax. Property tax in North Carolina, 0.86% value of the home, or at least the assessed value of the home. So $322 monthly, plus your utilities, plus your cable, plus your home maintenance, HOA, which you wouldn't have to pay if you're a renter. So this works out to about $2,940 a month. So yeah, a little bit more than $2,700. And then so the argument is, well, you know, I'm paying down, I'm building equity and I'm getting a tax break. Well, let's take this even further. In order to make this happen, you got to save up $90,000, and then there's also additional closing costs associated with it. Usually runs about 2.2%. So you need about $99,900 to get that conventional loan with 20% down just to get in. So what about a doctor's loan? So there are doctor's loans where you can get 3% down and with no private mortgage insurance, where you got to pay a little bit more whenever your loan to value is greater than 80%. Now, usually, so let's say 3% down, you need $13,500 plus the closing costs. So you're going to need about $23,000 at closing. Now, the interest rates on these doctor's loans are about, they say anywhere from 75 to 100 basis points higher than a conventional loan. So let's take that higher mortgage with a little bit of a higher interest rate, $2,200, $2,300 a month. Let's plug in all of these other things: home insurance, property tax, utilities, cable internet. Now you're at about $3,400 a month, compared to the $2,900 a month if you were renting. So let's talk about how much equity you're building. Now, at the beginning of the loan, when you look at an amortization schedule, your principal is very low. In this case, it's about 1/3 the amount that you're, 1/3, less than 1/3 is going into your principal that you're building equity on. More than 2/3 is, or actually, wait, 1/4, and then 3/4 is going into interest. And then, of course, it gets smaller as you get further along the amortization schedule. So in the end, you're going to spend about, in 30 years, let's say that you don't make any early payments, you're going to spend about $819,000 to buy this, for this home. And again, I like to translate it to working time. So that's 6.83 full working years, working full time, to cover your home, to pay for your home. So the white coat investor comes up with some home buying rules of thumb. Never carry a mortgage that's greater than 2 times your gross income. Now, that's kind of difficult for certain markets. Let's say you're in San Francisco. Let's say you're in New York. That's pretty difficult to do that. Spend less than 20% of your gross income on housing. So using the $180,000 example for a dentist, about $3,000 a month. And then his rule of thumb is spend 5% the value of the house to buy it, 1 to 2% per year the value of the house to maintain it, and then 10% the selling price to sell it. 10% usually would entail 6% commissions that you're giving to the realtors, the brokers during the transaction, and then probably a little bit more extras, with costs in terms of getting the home ready for to be sold. And also negotiations found in due diligence by the buyer. They're going to say, you need to fix this before we buy it. So, or renovating it. So let's look at several scenarios. Let's look at somebody that is bought a house, sells it in 4 years. Let's use the example that we have again. Purchased it for $450,000, 3% down. Let's use the doctor's loan. Lived in it for 4 years. In the 4 years, and then they sell it at the end of year 4. So they've made $109,000 in mortgage payments, $28,000 going to principal, $80,000 going to interest. And then the other holding expenses, using the formula from the white coat investor, is about $14,000 a year. So $56,000. Now, real estate has historically appreciated at a rate of 4%. Now, this year is significantly higher than previous years, just because of, the hot market that we're in. I'm gonna comment on this in the next slide. But let's use the average 4% annual compounded return in appreciation. So this leaves you at a home selling price of $506,200. That's great. So that's a profit of $56,200. That's what we think about when we're flipping homes. It's like, yeah, I'm gonna make $56,000. So let's subtract that 10% though. So the commissions, getting the home ready, paying for anything that the potential buyer demands in due diligence, the 10%. You're left with a net profit of $6,200. So, but then you also get your principal back. So that's 28, almost 20, 29,000 that you've accumulated in principal. And then I also factored in tax savings. What is the taxes you're going to save in paying mortgage interest? And so I calculated around 14,000. So you're going to net about $50,000. at sale. Now, if I took that 50,000 and subtracted it from the 4-year costs, so it works out to you having spent in 4 years, including the down payment, the mortgage that you spent, the holding costs, minus your net, 139,000 over the 4 years, which works out to about $2,900 per month. So this actually works out almost even with the renting. Now, what about if you're buying in a hot market like you are now, and we had some sort of housing bubble? Now, I'm not going to necessarily say that we're going to have one. Now, this is what happened to me. I bought at the height of a housing bubble in 2007. And so what happened was we ended up buying the house, and then 2008 hit, and home prices ended up going down. Now, mind you, the global financial crisis was driven by the irresponsible lending practices of the banks. Almost anybody can qualify for a mortgage. And then a lot of people that shouldn't be getting mortgages got mortgages and then couldn't pay their mortgage payments, make their mortgage payments. And so that's it almost, took down the entire financial system. We're not in a situation like that. There's much more stringent lending practices. And I think the prices of homes and the demands of homes are driven by demand demographics. The millennials, most of you kind of getting to that point where you're moving to the suburbs and having families. So the fundamentals are a little bit better. But this is what happened to me. I bought a house. We lived in it for 5 years. We renovated it, and then we ended up selling it for slightly less than what we bought it for. So I'm just kind of throwing this scenario here. Purchase for 450,000, same numbers. Total holding expenses are the same. Appreciation at 0% annually. Selling price, same. So you get zero profit minus the cost of selling, $50,000 from that 10%. Now you're offset by your equity buildup and your tax savings. So you at sale, you're down about just shy of $7,000. You factor that in with the 4-year costs. It's worked out to about a $4,000 per month expense. So let's look at the 3 scenarios again. Rent. Now let's assume that every year rents go up 2%. That's historically what usually it happens. So it averages about to $2,800 per month. We got the person who bought the house, sold it at a $56,000 more than what they bought it for, but then their net expenses were actually slightly more than the person that rented. So you're actually down $72 a month, $862 a year. So you're end up spending a little bit more to own your house. Fine. And then you got somebody like me, like what happened to me, bought at a hot market and sold and lost, ended up pretty much $1,200 per month down compared to the renter, $15,000 per year compared to the renter, $60,000 down compared to the renter over 4 years. So here's another video that I'm going to show you. Now, does this mean don't buy a house? No. I think there's many good reasons to buy a house. I think you come up ahead if you end up staying in your house long term. So here's kind of a video from the Berkshire Hathaway shareholders meeting. This is Warren Buffett on the left, Charlie Munger on the right. This was from 1998. Warren Buffett, one of the richest people in the world. And so in his Q&A session, one of the participants asked him, should I buy a house? This very question. And so let's listen to their answer.
We waited until 1956. We got married in 1952. We decided to buy a house when the down payment was about 10% or so of my net worth, because I really felt I wanted to use the capital for other purposes. But that was a way different environment in terms of what was available to buy. In effect, if you have the house you want to buy, I definitely believe in just going out and probably getting the job done. But in effect, you're probably making something in the area of a 7 or 8% investment implicitly when you do it. So,
I think the time to buy a house is when you need one.
And when do you need one?
Well, I have very old-fashioned ideas on that too. The single people, I don't care if they ever get a house.
When do you need one if you're married, Charlie? I'll follow up here for this. You need one when your wife wants one.
Yeah. I think you've got that exactly right.
All right, wise words from the Oracle of Omaha and his sidekick.
We waited.
So let's talk about retirement. And so the next question is, how much do I need to retire? And so I think I showed this slide in my first lecture, and this was from a survey of physicians, and this was their net worth. This wasn't even their nest egg. And so people that are above 65, let's assume retirement age of 65, about 60% were about anywhere between $1 million to $5 million net worth. Now, much of that net worth may be tied up in the value of their house. And then 25% were less than $1 million. And then, there were some that did really well, 17% that were greater than $5 million. Sounds like a lot of money, $1 million, does it? So next poll. Let's see if I can get to the next poll here. Let's see. Trying to get out of this one and go to the next one. Somehow I'm having trouble pulling up my next one here. Keeps on bringing up the. So that's the first one here. Okay, here we go. Here's the next question. How much do you think you would need as a nest egg to retire comfortably at age 65? There's just a few more that are going to vote. Okay, everybody voted. Let's share the results. So I think the winner was $3 million. And by the way, this is a different answer depending on the type of lifestyle that you want to have. And so it's individualized. So yeah, I think everybody says $1 million isn't really much now. $2 million, yep, 25% of you, $4 million or more. Depends on what kind of lifestyle you want to do. So, all right, let's move on to the next slide. So how much is it going to cost in retirement? And so I just kind of looked up some numbers. And so let's assume that you have no more debts, you paid off your mortgage, but you got to pay your, you got home maintenance expenses. And so utilities, maintenance, insurance, property tax, let's say this is monthly, by the way, $1,000 a month. Miscellaneous living expenses, depending on how extravagantly or how frugally you want to live, it's $2,000 to $6,000 a month. Now they estimated, where I found this source, they estimated that medical expenses are $13,000 per year, which would work out to roughly about $1,100 monthly. Now that's in 2021 dollars. How would this translate to what it is whenever you retire? And I'll get to that in a minute. So this works out to a range between $4,100 and $8,100 monthly. Now, I think the medical expenses is kind of conservative because medical expenses over time has actually outpaced inflation. So maybe by the time we retire, it's going to need to be considerably more. I'm going to get back to that in a second. And so what I want to talk about is the 4% rule. And the 4% rule is what most traditional financial planners go by. And so they're saying, and this was developed by a financial planner, William Bengen. And what he did was he took a lot of data based on a number of different portfolio allocations and try to determine, what's withdrawal rate based on the average portfolio allocation would least likely have you run out of money, before you pass away. And so the magic number that he came up with was, if you were to withdraw 4% of your nest egg in your first year of retirement and increase it 2% annually, there's a very good chance that you will do very well and you will not outlive your money for 30 years. So let's use that rule. And that's usually the rule that a lot of financial advisors are going to use whenever they plan for you. So let's use the assumption that somebody is age 27 now, 5% annual return, investing your money with a 2% annual inflation rate. So $1 million. To get to $1 million, if you're age 27 at these assumptions, you contribute $737 monthly. and you will get $3,300 of monthly income if you were to withdraw at, in 2021 dollars, if you were to withdraw 4%. However, at a 2% inflation rate, and by the way, I think this year they're projecting now inflation's been historically under 2% the last few years, although they're saying this year it's actually probably going to be 3 to 4%, for a number of reasons. I'm actually seeing it actually already going to the grocery store and even going to McDonald's. Yeah, I think I was paying a little bit more for things. They've gone up. So it actually works out by the time, if you're 27 now and by the time you're age 65 and you have 2% inflation, it actually works out to only about $1,500 a month. Now, can you live on $1,500 a month? Probably can't. $2 million, it's just double that, works out to about $3,100 a month by the time you're 65, if you're 27 now. $3 million works out to about $4,700 a month. So, okay, we're within the $4,100 to $8,100 range that we estimated in the other slide, the cost of retirement. And then if you got $4 million, it works out to about $6,200 a month. So a little bit more comfortable. So $1 million, saving up $1 million sounds like a lot, even $2 million, but it actually, this is what it's going to give you by the time you're age 65. Now, what about Social Security? If we were to add Social Security, I just took the estimation that they kind of came up for me. So let's say they say that that I'm going to earn $48,000 in Social Security. If you were to inflation adjust for that, that works out to an additional $1,800 a month. So there are some tools out there in terms of how you can kind of determine what your goal is for retirement. And this is a very good one I'm going to show you. It's the websites over here. And then of course, there's the spreadsheet that I made. I've also built in calculators for that. So the retirement savings calculator, the retirement income at age 65, assuming a 2% annual inflation, debt pay down calculator. So again, if you hadn't asked for this, certainly please feel free to let me know in the chat and you'll have this. So if we're to accumulate assets, the rule of 72 is that you want to take 72 divided by the annual interest rate, and that'll give you the doubling time in a number of years. So 72 divided by, let's say, a 5% interest rate, that's about like what, 12, 13 years. Can't do quick math in my head. So, if you get a 7% rate of return, that's roughly, you'll double your money in 10 years. Simple as that. Works for building asset, also works for debt. So how do we build our nest egg? And so it's a number of investment vehicles. Naval talks about you want to own things. You want to have ownerships and things. So I'm going to spend a little bit of time on these different investment vehicles. And traditionally, your financial planners will put you in a vehicle that really encompasses stocks and bonds. And so I'll probably spend the most time on that, but I'll talk a little bit about all the other ones too. So I'm not going to read what's on the slide here, but basically what's a stock? Well, stock is actually a partial ownership in a company. And so a company wants to go public and they want to raise capital. And so they'll issue public shares. And so that can be issued on stock exchanges. So you have a partial ownership of the company. And so the value of the stock, we traditionally know stocks that we want to buy a stock, we want the stock to go up. That's the increase in value, what the market determines. But the other value from stocks is any income that it can generate. So if the company, for instance, makes money, they have a profit, and instead of reinvesting the money into expansion of the company or capital expenses, they want to distribute the profits to the shareholders. Those are called dividends. And so there are two main types of stock. You got common and you got preferred. Common stock has more voting rights, but however, they're last on what they call the capital stack. So for instance, if the company was to go bankrupt, they're the last people to get whatever assets are available. Preferred stockholders are probably the next step up. If there's a little bit of money left over, they're probably going to get paid first if the company goes bankrupt before the common stockholders. However, they don't have voting rights. So if we were to look at stocks over the S&P 500, which is an index of 500 companies in composite, and let's say you were to own a basket mirroring the index, the S&P 500 index, for 20 years. And these would be your average annual returns depending on the year. And so if you were at the time of the tech bubble around year 2000, because stocks really skyrocketed at that time, the average annual 20-year annual return for that time was pretty high, 14 years. So in other words, if on January of 2000, you would get an average annual return if you had it for 20 years of 14%. And that significantly went down, as there was the bubble there. It went down even further if you were in January 08. So in January 09, for instance, if you held stocks, if you held an index, the S&P index for 20 years, your average return would have been 5%. So it fluctuates. However, so you hear things ranging from 4 to 8% if you were to hold the index over time. So what about bonds? Bonds are stocks are ownership in a company. Bonds are actually a company borrowing from you. So it's a unit of debt. And so you are being paid some sort of interest rate to loan the money to a company, the US government, municipal government, whatever. So it's an IOU. And so it's actually a fixed income instrument. It's used in portfolios to generate income. So the interest rates are determined based on the federal funds rate, which is the amount banks have to pay Federal Reserve to borrow money. Now, the federal funds rate right now is very, very low. It was done that in order to stimulate the economy. And so bond prices, your bond interest rates are very low. So you're not going to get much fixed income if you buy a bond. The other value of the bond is that they're inversely correlated with interest rates. And so when interest rates go up and you're holding a bond that gives a particular yield, and the bond price, it becomes less valuable because people would rather go out and buy a bond that would give a higher yield if interest rates go up, and vice versa. If interest rates go down, which it has been for the last 30 years, the value of your bond goes up because you're actually holding something that has an interest rate that's higher than what is the prevailing interest rate if you're to buy. So its value in a portfolio is less volatile than stocks. Examples of bonds, probably the safest one theoretically is the US Treasury, like a T-bill. You're actually, paying money to, this is what's funding the government debt. You've got an IOU on the US government. So what are the odds that the US is going to default on that loan and you're not going to get your money back? So theoretically, that's probably the safest. You got foreign ones, foreign governments, state governments, municipal bonds, corporate bonds issued by companies. Now, the companies are like individuals. We talked about credit score for individuals. If somebody's got a good credit rating, they're highly rated. If they got a lower credit rating, they got a lower rated. Companies are like that too. So theoretically, those that are more risky should have a higher interest rate or coupon, and companies that are better credit ratings should pay a lower coupon. So again, interest rates over time have gone down significantly. So in the past, portfolio managers relied on interest rates and the coupon that they were getting, the income from bonds, to fund their accounts or to generate the income from their accounts. That's not the case now. Interest rates are so low, you're not really getting much income from it in yield. And so really the purpose of the bond really in an account right now is really just to kind of ease off the volatility. The stocks go up and down based on the market whims. Bonds kind of, since they're less volatile, they kind of lessen that volatility. So the next thing is mutual funds. Mutual funds is a basket portfolio of stocks, bonds, and other securities, not just those two. So you're having somebody kind of put together a portfolio for you. And they can be divided into several kinds of categories representing the kinds of securities they invest in. So you can have mutual funds that are strictly on US stocks. You can have a mutual fund that mimics the S&P 500. It's an index fund, which I'll talk about. Now, because they are being managed, they charge a fee. And that fee will cut into your annual gains. And I'll talk a little bit about that. Now, the overwhelming majority of money in employer sponsors retirement plans goes into mutual funds. So here's an example of the mutual fund catalog offering at our institution. And so you see a number of these target date funds, and I'll talk a little bit about that in a bit. And then some other ones. You got some international stock funds, you got small cap index funds, so for smaller companies. You've got a total stock market index fund, so that just mirrors the entire stock market, US stock market. You got a bond fund, you got a money market fund. And so by default, well, I'll talk a little bit about this in a minute. Now, the funds, you also got open-ended and closed-ended funds. And then you also got load and no load funds. And the loaded funds are the ones where in order to buy the fund, it charges a commission. A lot of times the commission goes to the financial advisor that recommended that put that money into it. And so again, an example is, one of our financial advisor in Canada who manages our money, he makes his money off of us by putting us into loaded funds. Now we're kind of limited because, now that we live in the States, we couldn't really trade in and out of the mutual funds. So we just decided to leave it in there. So he's making his living off of putting, having put our money into a mutual fund that has a load or a commission. The other thing about funds, mutual funds, is that let's say you have it in a taxable account. There are transactions within the mutual funds. And let's say that the fund manager decides to sell a stock for a capital gain. Now, he can either distribute he or she can either distribute the money to you as a kind of like a dividend, or they can reinvest it within the fund. Well, regardless of whether they distribute it to you as a dividend or invest it in the fund, you're going to get taxed on that. And so that's why mutual funds are not very tax efficient. You're going to get taxed on all the capital gains that occur within the transactions in the mutual fund, in the event that you hold a mutual fund in a taxable account, not a non-tax exempt account. So, so there's a disadvantage there. Now, the other thing is, what about active versus passive funds? So this is a picture of the late Jack Bogle. Jack Bogle was the founder of Vanguard. He came up with the idea of, well, instead of having somebody put together a portfolio of what they feel are their preferred funds that will do better, that will perform well, why don't we just put together a mutual fund that mimics exactly the composition of the S&P 500? And it was revolutionary at the time when he introduced it in the 70s. So when you look at the performance, at least in the US market, of actively managed mutual funds, where you got a fund manager trying to outperform the market or try to gain, get optimal yields, versus index funds, on average, and this is in the US, they have underperformed. The managed fund by a fund portfolio manager has underperformed the index by 1.8%. And you can see this here on the upper left slide. Now, mostly in the case of the United States. Active funds, in roughly about 1 to 2%. Now, I could see the case is kind of a little bit different when we're talking about other asset classes. So when we're talking about foreign funds, real estate, actually, the index funds did better. And the bond funds, I think in this case, the corporate bonds funds, the active did better than the passive. So, but anyways, the other piece of it is that there's an expense ratio associated with these funds. So not only did they do worse by 1.8%, but they also cost more. The expense ratio, when you look at a mutual fund, is the amount that they charge just to manage the fund. And so if you've got a passively managed fund like the total stock market index fund, well, they don't have to really do much thinking and manipulating. And so their expense ratios are actually the lowest. In this case, it's 2 basis points. However, if you got a smart retirement fund, which I'm going to talk about, which is kind of a basket, kind of a mini portfolio, it's a little bit higher, 0.47%. And then you got an international stock fund where they charge 0.6%. So if you were to compare the results, let's say you got a 6% return and you were to subtract that 2 basis points and you were to invest $2,000 monthly, and for 35 years, this is how much you get, your final balance. And so there's a $400,000 difference just from that actively managed fund, assuming that it performs exactly the same as this passively managed fund, just because of expenses. On top of that, let's say that a fund like this performs 1.8% worse than an index fund. that takes your balance even lower. So your returns, so the argument is that Jack Bogle said was, why don't you just put it into a low cost index fund? If it doesn't, if it does better than the actively managed one and it's cheaper, it's got less expense ratio. So this one, I'm going to talk a little bit more about the asset allocation, worked out, also a little bit less when you compare it to the index fund. So about a $300,000 difference. So more notes. So Jack Bogle said of the 355 equity funds, 233 of those funds have gone out of business. 24 outpaced the market by more than 1% a year. Those are terrible odds. So you're, in other words, if you were to play the odds, you probably do better passively investing. And so Warren Buffett, again, he says a low cost index fund is the most sensible equity investment for the great majority of investors. And so that's what he recommends the average investor do for that very reason. Other asset class exchange traded funds, they're kind of like mutual funds. The only difference is that they are structured differently. The share prices fluctuate all day. Mutual funds basically fluctuate in price at the end of the day. Here, they're kind of bought and sold on an exchange, on the stock market, anytime during the day. They can contain all types of instruments, again, just like mutual funds. The advantage is that generally their expense ratios are cheaper. There's fewer commissions, and you don't have the taxation issues that I talked about whenever there is selling and distributions, with inside the fund. So let's talk about real estate now. Because this is something that I'm engaged in, I can probably spend an hour, 2 hours talking about. I'm only going to spend the next few minutes about this, but it's another asset class. Now, we talked about real estate, buying your own personal home. Well, what about as an investment? So traditionally, there's direct ownership. That's the one that we traditionally know about. So people are thinking, okay, we've got a couple investment properties that we directly own and manage in Florida. So that's part of our portfolio. There's also passive ownership. There are companies out there where you can actually buy a house. They'll find the house for you. They'll kind of give you the projections of how it's going to turn. And then, you put the down payment or whatever the investment is, and then they'll manage it for you. So you're not going to be responsible for, fixing leaky toilets at 2 a.m. It's the company that you buy it for is doing that. Syndications. So what's a syndication? So what it is it's a group of individuals that pool their money to buy a real estate asset. Well, in this case, a real estate asset. So I'm passively invested in a real estate syndication for a townhome development in Raleigh. And so the person that's the deal sponsor ends up, getting investors. Usually they try to aim for 8 to 10% returns. And overall, over the life of it, if you include the profits of it, theoretically, a typical syndicator would want you to double your money in 5 years if you include the gains you get plus the proceeds upon sale of it. So that's another way you can passively invest in real estate. There are real estate funds. It's kind of like a mutual fund that's strictly for real estate. They're a little bit more private. Entry level is a little bit higher. And then there's also crowdfunding. There's sites, which I'll show you in a minute, where you can pool smaller amounts. They're kind of like syndications, but larger number of investors. They're internet sites and platforms where you can passively invest your money in. Now, a lot of these things are not necessarily going to be offered by your traditional financial planners. They're usually going to try to put you in a portfolio that's strictly stocks and bonds. And then there's nothing wrong with that, but I just kind of wanted to show you what other things there are. Now, real estate investment trusts are traded on the stock exchange. And so these are, they hold various different real estate type assets. So pretty much I'm invested in real estate in all of these things except for turnkey ownership in real estate funds. And then there's alternative investment. You could be an angel investor. So you got somebody that's a startup and you're putting a little bit of seed money into a company. And let's say the company takes off, then the gains can be really huge. Now, however, there's a lot of risk involved because more companies fail than take off. Private debt, these are kind of like bonds in a more smaller scale, where you can invest in lending money to somebody who needs it funded for a construction project, and then they're going to pay you a higher return, like 12% for the year that that you're lending them the money for. There's commodities, there's gold, silver, things like that. Now there's exchange traded funds that hold commodities. That's how I hold my allocation of that in my retirement portfolio. And then of course there's cryptocurrency. We're hearing a lot about Bitcoin, Ethereum, and all, Dogecoin. And so, I'm not going to really spend too much time talking about it. However, I do have a significant exposure to that. Very volatile, very risky. However, there's an argument out there that this may replace currency as we know it. And then there's collectibles. There's actually sites where you can crowdfund partial ownership of collectibles as an asset. Now it's not an asset that actually gives you cash flow. It's an asset that actually is a store of value. So the one that I have pictured here is by an artist called Rothko. That's like a $16 million paint. They offer crowdfunding in real estate or legal. Let me see if I'm just getting a notice that my internet connection is unstable. Legal finance, where you're lending, lending for ships. So I got a couple of investments in there. And then here's a list of other places and platforms where you can invest in alternative investment. Equity Multiple is in real estate. AngelList, Naval, this is Naval's company, where you can invest in startups. Grayscale is a platform where you can invest in cryptocurrency. So there's ways that you can actually invest in these things outside of the traditional offerings that financial planners are going to give you. And you can do that inside a retirement account. And so talking about asset allocation, the simplest way to have a diversified portfolio is to just put all of your retirement assets into what we call a target date fund. And what they do is based on the date, the later it is, the more that they're going to have exposure to more risk, what they call risky assets like stocks. And so this 2055, and then they're going to rebalance it, and then they're going to adjust it accordingly as you get closer to 2055. And so you don't necessarily need a financial planner to do this. Just put all of your money into this one fund, and you've got somebody managing that portfolio for you for a 0.47% fee. So that's the easiest way to put together a portfolio. Have somebody do it for you. Now, this excludes a lot of these alternative investments that I talk about. Or what you could do is kind of put together a basket of index funds. So the simplest one is you got 60% in a total market stock fund, Vanguard index fund, and 40% in a bond fund. And this just kind of shows you the different returns historically based on these different allocations. Now, this is from 1926 to 2020. And so you just kind of, you just put it into that certain distribution. Whenever stocks go up, you sell some of your stocks in order to compensate and buy more bonds to keep that 60-40 ratio. You do that once or twice a year. So that's another way of doing it. Now I'm going to show you how I have it. Now, again, I'm geeking things out. This is my current asset allocation in my retirement account. And so it's much different. I'm just showing you this just for the sake of demonstrating how I'm diversified. It's not really an endorsement of a way to do something. This is what I'm doing. Is it right or wrong? This is just what I'm doing. So a lot of these others are really in passive investments in real estate syndications. And I was able to do that inside my retirement fund. And I'll talk a little bit about that. Now, my crypto portion of it inside an ETF, well, it's not really a true ETF. It's a trust that holds Bitcoin and Ethereum. I think dropped significantly today. So very volatile. So you want to keep your more riskier assets at a smaller allocation. You know, where the downside, if it were to go to zero, my portfolio goes down 7%. However, if it goes up 10x, it's gone up 70%. What about individual stock trading? So what if I put all my money in something like Amazon? Well, if I put my money in Amazon when it was here, I would be very wealthy. Yeah, that's great to say that in hindsight. I think the only person that probably has held Amazon from its inception to now is Jeff Bezos and his ex-wife, because the average person is not going to sit through this. So between 1999 and 2009, you can see Amazon pretty much had a 90% drawdown. And then again, in the global financial crisis, that's pretty much like a 60% drawdown. Now, are you really going to sit and hold that? Now, you can make an argument that, well, you know, I can try and trade in and out of it and try to sell when it's here and then try to buy when it's here. Well, I think it's very hard to do that. Many people do that. You know, that's the game that we play. I think the natural tendency, human nature, is to want to, when you see something going up, you want to buy, you want to get more because you think, you know, you're gonna buy more. And then when it goes down, you want to sell because you're afraid that it's going to go down more. And so in hindsight, it looks easy to do this. It's very hard to do this in real time. I'm going to kind of skip this for the sake of time, just because we're running out of time here. So I just kind of wanted to comment on stock picking versus the index. So the US stock market had annualized returns of 14% per year. 9 out of 10 years, the whole market was positive for the year. Only 42% of the individual stocks were positive for the entire 10-year period. 36% are negative for the 10-year period. 22% of these stocks are gone, either out of business or have merged or been acquired. And then 4 out of 5 stocks have trailed their own benchmarks. So the take-home message is stock picking is difficult. And like we established, if the portfolio professional managers can't outperform the index, who thinks that you can? Now, does this say don't do any stock picking? No, I still do some. I've allocated a certain portion of my portfolio to that, but you want to allocate accordingly. I want to spend I think we're running pretty short on time. I want to talk about retirement accounts. Let me just take a look at the chat here. If I run a little bit over, is that okay? You know, feel free to jump off. You can always look at the recording, but I do want to go through all of this. So, so again, I apologize if I run long. You can always refer back to the recording if this is getting long for you. But I do want to talk about retirement accounts. So there's a lot of information that we're covering. So read your plan document that your employer is giving you, understand what's tax advantaged, how they work. So there are private practice 401ks, there are defined benefit plans in academics and public institutions. They're called 403Bs, 457Bs. Now where I'm at, we also have a 401A in addition to a 401k. Your eligibility in the 401A is dependent if you meet certain thresholds for your income, and that's institution specific. Understand all tax advantages accounts available to you and how they work. And so self-employed, you can set up your own individual 401k. You can, and these are all individual self-employed IRAs. Everybody can set up what we call a backdoor Roth IRA. And I'm going to talk a little bit about what that is. At our institution, we also have a health savings account. It's a great tax advantaged vehicle. I'll show you why. And then there's also 529s for college. I do have those set up for 2 out of my 3 kids. So the advantages of having a tax deferred retirement account is, number one, it lowers your taxable income and it allows it to compound, and then you end up paying the taxes later. But you have higher returns in doing so, as illustrated by this picture. And so a 401k, if you were to make your pre-tax contributions, anything that you contribute to your 401k up until the limit is effectively reduced from your taxable income. So if you contribute 20,000 or 19,500, then that's 19,500 less that you will be taxed. So it's, and then also it grows tax protected. You're not taxed on the growth. So the maximum contribution is 19,500 for you. However, the combination of you plus your employer is $57,000 annually. Most employers will have some sort of incentive where they will match. And so I think, like, for instance, if you were to contribute 6%, we'll match 50 cents for every dollar that you contribute up until 6%. So essentially, if you contribute 6%, then they will contribute a total of 3%. That's 3% of free money. So take advantage of that. That's why it's number one in the waterfall. Asset protection. The other thing is, let's say you got sued. Is this money protected? Well, the ERISA Act actually protects your 401k from creditors. So it ensures the safety of these accounts to protect your retirement, even in the case of a lawsuit. So that's another advantage. Now, you are not taxed on its growth, but then when you take the money out, that's considered taxable income after age 59 and a half. If you were to pull the money out at age 59 and a half, you actually pay a penalty, which is 10%. So what's an IRA? An IRA is also a tax-deferred retirement account. You can do pre-tax contributions, upfront tax. So again, that's reduced from your taxable income. Maximum contribution is $6,000. You got tax-protected growth, just like your 401k, and it also has a degree of asset protection up until $1 million. For bankruptcy and also for lawsuits. And then again, just like your 401k, whatever you accumulate, it's grown tax-free. If you pull it out before 59 and a half, you pay a 10% penalty. And then whatever is pulled out is considered taxable income. What about a Roth IRA? A Roth IRA is actually, you are contributing with post-tax dollars. It doesn't count as a tax deduction or a tax credit. However, it's a vehicle for savings. It grows tax-free, and then also whatever you take when you get your distributions when you retire is also tax-free. And so there's the advantage right there. Now, if you're making more than $140,000, you can't contribute to a Roth IRA. $140,000 if you're single, $208,000 if you're filing jointly and you're married. So if you're under that, it's probably a good idea to contribute to this. And that's why it's also early in the waterfall. Maximum contribution, just like the conventional IRA, is $6,000. You can withdraw contributions tax-free at any time. So it's actually also a savings vehicle. That's the other advantage of it. So let's say you've contributed over the years 30 grand. You can actually withdraw that 30 grand, the principal that you contributed. Now, if that 30 grand grew to, let's say, 50 grand, you can still pull out the 30 grand tax-free. But if you pulled out that additional 20 grand of growth, it will trigger taxes. And so it's kind of another form of emergency savings that you have at your disposal. So what about as a resident? Do you want to contribute to a traditional IRA or a Roth IRA? And so I think it really boils down to, is having the tax-deferred upfront tax break advantageous for you? So number one, make sure to get any employer match if you're in a 401k. Go up to that, whatever, 6%. That's free money. If you will probably be in a higher tax bracket in retirement than you are in residency, depending on whatever the tax laws are at that time. So if you've got no federal student loans that are dependent on what your effective adjusted gross income is, then it's probably a good idea to contribute to a Roth. However, it's probably better to contribute to a traditional plan if you want to reduce your adjusted gross income, because that affects the terms of your repayment of your loan, both in terms of how much you pay and also the subsidizing factors of that. So that's where the decision making, if you're trying to decide whether you've got extra money, whether to put it in a traditional versus a Roth. So what is a backdoor Roth IRA? So this is a situation where if you're over that threshold where you're no longer eligible to contribute to a Roth IRA, you can kind of do it kind of a backdoor style. And so what you do is you contribute to a traditional IRA, and then one time you convert whatever you have in your traditional IRA into a Roth IRA. Well, what does that do? Well, let's say you contributed, you've got $10,000 accumulated in a traditional IRA and you decided to convert it to a Roth. Well, the year that you convert it to a Roth, that $10,000 is actually going to be considered taxable income. So you will be taxed on that. On top of that, you want to close all other IRAs that you have the year that you make that conversion. And so one way to do it is just to convert any small IRAs to a Roth IRA whenever you make this conversion. And then now let's say if you got a large IRA, you can always roll it into a 401k. You can roll IRAs to 401ks. You can roll 401k money into IRAs and then close whatever other traditional IRAs you have. So you have this backdoor Roth. And so this is one strategy that you can use if you want to accumulate a Roth IRA, have non-taxable income when you take your distributions in retirement. Another thing, now most traditional plans, remember how I said most employers will only offer that basket of mutual funds, you can set up self-directed IRAs or solo 401ks that have access to investments in a lot of these alternative platforms. So theoretically, you are not limited to investing in stocks, bonds, and mutual funds. You can invest in anything. So I've set up a couple self-directed IRAs, and that's where I am investing my crowdfunding. That's where I'm investing my passive syndication in real estate. So just wanted to throw it out there. It's another option because your retirement account is simply not limited to whatever traditional financial planners are offering you. A couple more things. Health savings accounts, you must have a high deductible health plan. The nice thing about health savings account, it's probably actually the most powerful from a tax standpoint vehicle because it is a tax deduction for contribution. It effectively reduces your adjusted gross income. It grows tax-free. And then if you're using it for healthcare after you're retired, it's also a tax-free withdrawal. And the other thing is once you set up an HSA, it's portable. So let's say you're working at University of X, you contribute to a health savings account, and then you're now moving to University Y. Well, that account is yours. It goes with you. And it's yours until you retire. And so at age 65, you can actually use it to spend it on anything penalty-free. However, it's considered just like a 401k, taxable income. So if you're using it for healthcare, you pull it out, it's not taxable income. If you use it for buying a boat, it is subject to tax, but you could use it for buying a boat. So, and then the other thing is withdrawals need not be in the same year as spending in the case of a health-related expense. So I think we're wrapping up here. I know I ran a little bit long. Hopefully, I'm willing to stay on as long as you need to if there's any questions. So pick a reasonable investing plan, broadly diversified between asset classes, stock. It's not just limited to stocks and bonds. There are other things. There are real estates. There are alternatives. However, if you want to keep it simple and set it and forget it, you can probably just, put it in a target date fund. You don't even need a financial advisor to do that because it's already managed for you. Broadly diversified within asset classes. However, index funds are probably your low cost, probably best performing asset class to do that. You want low cost, less than 2 to 20 basis points per year. So 0.02% or 0.2% per year. You don't want that to eat up into your gains. Appropriate amount of risk. Can you put cryptocurrency in there? Sure. Can you have a small portion where you trade stocks? Sure. Can you put some into angel investing? Sure. But you want to have the appropriate amount of risk. The more riskier it is, the smaller the allocation it is, because you got to be ready for that to go to zero. Fixed asset allocation, do this realistically, rebalance periodically. So the financial pyramid, when you're looking at levels of risk, more conservative investments on the bottom as your foundation, more risky investments on the top. The slide that I kind of skipped was the example of a 20-year-old trader on Robinhood that engaged in some risky trading practice where he traded options and somehow ended up with options on margin where you borrow the money to trade and ended up with a negative $700,000 balance, and because of that, committed suicide. And so that's high risky behavior. You don't want to do that. Do you want to engage in it? Sure, but you just want to be able to manage your risk. Now, what's the ultimate goal? Ultimate goal is financial freedom. Financial freedom is where you don't have to rely on you physically working to pay for your lifestyle. And so that's where we talk about building your assets, whether it's rents, royalties, interest, dividends, distributions, capital gains. That's the ultimate goal. And so you can work on your own terms. And so that's what the working should be for, is to kind of build your assets. It's not to fund your lifestyle. If you fund your lifestyle, you're going to find yourself not building wealth, not building rich, and finding yourself working much longer than you want to and much more than you want to. So what is the initial financial education? Now, this is straight from the White Coat Investor, some personal finance books to get started. I'll just leave this up there. Again, you can always refer to it. A nice simple book is If You Can by William Bernstein if you're starting. There's a website here. Actually, it's a free PDF. I just realized, I had it highlighted, the hyperlink in blue. Maybe I'll just send it out to you afterwards. And then put a written financial plan in place. Either learn how to put one together or hire a fee-only financial advisor, pay the few $100s to $1,000 to help you put one together and advise you along the way. And I talked about, assets under management, financial advisors, what their roles are. So take home points. And I apologize again for running over. Pay your future self first and your current self last, because anything that you spend now is really going to result in your time working later. We talked about the 60-20-10-10 rule in terms of your cash flow plan as opposed to your budgeting plan. We did the waterfall methodology. What do you do for things that are outside of that 60% fixed cost and that 10% fund money? How would you prioritize it? Debt pay down versus investing. I just mentioned, as Naval said, working for things will not lead to security wealth. Building assets do that. Build your portfolio of assets that you own, whether it's investments, real estate, your practice, whatever. Buying a home is more than just comparing rent versus a mortgage. So please do not fall into that trap when making that decision. $1 million at retirement is not really a lot. It really only translates into what, $1,000 a month. You can't really live on $1,000 a month at age 65. Using the 4% rule. So that's your target at retirement, at least used by traditional financial planners, unless you've got some other passive stream of income at retirement. Now I'm just talking strictly for your nest egg. We want to take advantage of the power of tax advantage accounts, like your 401ks and your IRAs. Stocks and bonds are great foundational investing vehicles into assets, but they are not the only ones. But if that's all you use, that's fine. Asset allocation is the most important factor in terms of your success in growing your portfolio. And then I think the last one, I took this straight from the White Coat Investor. Unless you enjoy doing it like I do, when you realize that nobody knows nothing, just like your portfolio managers or your individual stock pickers, it frees you to quit wasting time on activities that don't add value unless you find the value in the activity of doing it. And then have a spending and investing plan, then go ahead and live your life and enjoy it. So with that, I went way over. Let's take some questions, if there are any.
I have a quick question.
Sure. Go ahead, Dr. Ikeda.
So if you, with the knowledge you have, if you were to graduate residency this year, would you buy a house or would you not?
No, I would not buy a house.
And why would you not?
I think the numbers spoke for itself. And you can, and so, but I think, and again, based on my experience, I came out losing doing that. Now, are we going to have a global finance? But I think the numbers speak for itself. Now, I know there's the worry, there's the FOMO of, there's FOMO. I think we see housing prices appreciating the way they are. And so there's always the fear like, well, if I don't buy now, I'm not going to afford later on just because it will be out of reach. So you can make that argument. But I think I laid down the argument here in hindsight. Now, this hindsight's 2020, and I'm hoping to kind of share some of that hindsight with some of you, that you're actually not really ahead in buying that house. So objectively, no. Now, probably would have I done it? Probably, I probably still would have done it just because I know it's the thing to do. You work so hard. So, so my current self's, with the wisdom I have, would tell my 28-year-old self not to do it.
So let's twist a little bit. So let's say if you have 100,000 right out of the residency program, where would you put this 100,000? Again, let's assume you are right out of the residency and you have a student loan, and would you put that money, all of them in the investment, half of them in the investment, or do you actually apply the 60, 20, 20, 20, 10, 10 for that money you actually have in the bank right now? Or what would you do as a new graduate, having those bunch of things they have to pay off? Do you prioritize to pay off it, or do you separate them, trying to pay off more and put more money in the investment? Or what would you?
I think, again, knowing what I know now, and then again, this is not financial advice. This is just hypothetically. Usually I'd probably sit down and do the numbers, but let's say quick math. Probably my instinct is to do a little bit of all. Knowing what I know now, and this is not necessarily the path that most of you would take, with our real estate investments. I would have bought a duplex, lived in, I would have taken some of it to buy a home that would have been a duplex, lived in one of the units, live in it for free, earn a little bit of money off of it, maybe take a third of it into a retirement account. So maybe a third for buying a house, a third for starting the nest egg fund, and then maybe a third for debt pay down. That's probably what I would do. But what would you do? So
there's so many theories, and a lot of it's not just math, psychological. So it really So it depends on your so Dave Ramsey caters to the people that have trouble more with debt and with their behaviors and overspend. But then if you don't have that mindset, like that's what I realized in watching different financial people, it all really depends on their own financial ability to say, I have my student loans, and my student loans were 6 to 8% interest rate. So that would fit above the mortgage on your list that you had there from, I think, the white coat investor.
Ryan Inman's.
Yeah. And so mathematically, say you have, a big loan with big interest, you want to, you're checking away at that. Dave Ramsey's, because he's catering to people that have spending issue, he does the debt snowball, which is actually paying down just your lowest amount of debt and not even looking at the interest rate, because then that sets the behavioral pattern versus, like, say I had $300,000 worth of student loans, which I did, and me chipping away at that wasn't getting anywhere. I can be demoralized and all of a sudden I'm not paying anything. But I had this smaller, I had mine broken down into a few different categories. So I had, the Perkins loans, and even though those loans had less interest rate, I put those down, and that started the momentum to then start paying back more. So I think mathematically it's really hard. It weighs in so many different factors with your spending behaviors than just looking at an interest rate. And Tough questions, Dr.
Yeah, no, it's a great question.
Yeah.
Yeah, and and I think I think here is just to kind of give some guidelines that I found, kind of interspersing it with my experience. And again, this is my opinion. I'm not a financial planner. I'd like to hear what the financial planner next month says.
Absolutely, I think they'll say the same thing you did. I think yeah, you looked for research, which is awesome. I think what's awesome too is that you share different, a lot of different recommendations from different resources that you have gleaned, and you always say, this is what works for me, here's alternatives, and that is really helpful.
And what was I going to say? Thanks, Dr. Riggert. One point that Jimmy Turner makes is that for physicians and high income earners or dentists, strictly following Dave Ramsey doesn't necessarily work. Because there are advantages in deferring the debts, most notably the student debts, because you can use it in favor of other instruments that would grow at a faster pace than the debt that you're paying down. Now, it's easier to say that in theory, but I think there's a lot of psychological component to it, right? What's your comfort with having debt? And now the interesting thing is, just the case study that I used, paying down the debt aggressively and then saving afterwards actually worked out to be this better in that particular case than doing a little bit of all. But there's a lot of assumptions that we had to make, there. And are those assumptions are they actually going to pan out? So, and then going back to Dr. Ikeda's question, what would you do? I don't think, I don't think it would be one or the other. I think it'd be a little bit of all. And that goes back to diversification. And, now some people, they're very uncomfortable with debt. I know and they decide to aggressively pay it down. So there's no one real answer to this. But so I just kind of wanted to throw out different scenarios and what the pros and cons are and how to think about it.
Even I can give you, I know I talk a lot, but we talk from experience, right? So even though I paid down mine aggressively, I looked at a Roth that I had opened in 2007 and only invested once. So hindsight, I wish I would have just done the max investment that I could at the time for each year. That's a hindsight, while paying off debt. Then I would have had some momentum going with my Roth and just been gaining insights on how to manage my portfolio at a younger age, because now I have hired a financial advisor and I don't have a lot of income, but I just feel like I need somebody to push me a little bit more. And feedback I get is that I hoard money too much. I have such a fear of spending that I'm actually on doing myself a disfavor. So
yeah, there's two reasons. You're not enjoying life, and give yourself that 10%.
Yeah.
And then the other part is cash. We talked about inflation, and now I use 2% as as the historical inflation rate. You just put your money in cash and you're already losing 2% theoretically every year. I think it's even going to be more. 40% of the dollars that are in circulation now were not in circulation 2 years ago. So just think about that. So what is the relative value of our money now when there's so much more of it around? So and the point I'm making is just having it sitting there in cash is not, it's a guaranteed loss.
Absolutely. It's riskier because it's a known risk, a known loss, than taking a chance that you could potentially gain. So, and Dr. Ikeda, so my brother is very, very well off, and he just spent $1.5 million, and Zillow said his house was $800,000, and he's in the Denver area, which I know you can appreciate the market there. So I think it also depends on the difference. So I sold my condo here in Ann Arbor in less than a day, and I sold it for asking. A couple of weeks later, all the places around me and just under the 200 mark are selling, or over that, for the ones that are selling now, are going for 20 to 40,000 above asking, and then it just grows exponentially depending on what the base value would have been for the house before COVID. So I think there's a lot of factors that would go that would be involved in you being in the Boston area. You know, you gotta really love your house. Gotta love it.
Yeah, I think it's tough in those markets. I think, go ahead, Dr. Ikeda.
Well, I 100% agree, and I just wanted to get your own opinion about what you would do, but also probably some of the residents may be graduating and looking into private practice. That situation will be much different from me or you. And may want to save some to with the vision of opening up a practice, and that's a good investment too. That you need money to open your own practice, and that's a good. I think that's a good way to invest into your future with the possible revenues and those you're going to generate and those. Well, my advice to young people is really the worst thing you can do is do nothing. So thank you for the Joe. Thank you for the great presentation. But I wish I knew those when I was a resident. And I did nothing for years and years, and recently started thinking about those. But in my opinion, the worst thing you can do is really do nothing. Just think about those. At least think about those is the good starting point, I think.
I wish I knew this stuff 5 years ago.
We always do.
Let alone being a resident.
Like, man, we learned stuff the hard way. Gosh, but there's also on top of yours, I know I sent you my financial advisor that I got.
Yeah, they got a good podcast. They got some good information.
So mine is the people that are on here. They're dentist advisors, and I was somebody that's like, I don't have any money. Why would they even want to work with me? But they negotiated a price that was more within my economics because I'm not complex. I'm not private practice dentist. So they do cater to dentists. They're very well versed in things that pertain to dentists. So I would strongly recommend them. They come out of Utah. They're smaller, very trustworthy. With the one that I'm working with, the ones that did the webinar, just really valued the way their approach. And again, when it comes to finances, especially as dentists, we're seen as high income earners and we get targeted. Sometimes I get called from the Fisher Investments or people that think I have bazillions of dollars. And so it's hard. It's very important to make sure that we have a good rapport and trust our financial advisors. And so these people gain my trust and are helping me, Dr. Ikeda, from doing nothing, which is my risk averse strategy that has not served me well. So,
I think you conquered a big one by paying down your debt. So that was not doing nothing. So it's taking the next step. I want to answer your question about entry point in syndications. Now, syndications, it's generally a higher entry point. So typically the entry point is, the lowest I've seen is $25,000 minimum investment. The typical is $50,000 minimum investment as a passive investor. But some from our more established and reputable deal sponsors that have a track record have $100,000 minimum investment. So, the lower barrier entry. And the other part is that you have to be either what they call a sophisticated investor or an accredited investor. So an accredited investor meets certain criteria. You make over 200,000 a year, file single 300,000 filing jointly for the last 2 years, or you have a net worth greater than $1 million that excludes your personal residence in order to be an accredited investor. Now you can be a sophisticated investor for certain offerings in which, have you demonstrated some sort of education or knowledge in finances, and there's just ways that you got to demonstrate it by your, questions that you answer, or and these are SEC regulations, by the way, in order to participate in a syndication. Now, another way to participate is A lower way you can introduce into real estate is REITs. However, REITs do tend to fluctuate with the stock market, even though it's based on real estate. So I just wanted to make sure I answered that question. Last thing I want to do is talk a little bit about a story, talking about stock picking. We're talking about what we knew in our youth and what we didn't know and the stupid things that we did. So I'll tell you my story, my stock picking story while I was in dental school. So there was a bunch of guys, and it's funny, I still get texts from them about certain stock picks or, Bitcoin and things like this. But we were in dental school, and I had saved up, my father had saved up maybe several $1,000s for me, and, kind of gave me access to it. And then our buddies in dental school said, oh, there's these two great software companies. And I remember what they were, TCC and BPP or something like that. He goes, I got this tip, we got to invest. And so there was about half a dozen of us that actually put our money into it. So I put that entire, which was a lot of money for me at the time, $3,000 into those two stocks. And now I had a classmate who used his line of credit and invested in these two stocks. And I remember he was like, well, if I'm going to go big, let's go really big. And it's safe to say within 2 years, those two stocks went to zero. And so I learned my lesson the hard way. But that's my dental school story about stock picking. So BPI and TCC, I just forever am, that's that, learned the hard way there. So any other questions? Otherwise, I know we're way over, so appreciate everybody that stayed here as long as they did.
I was just thinking, that book you referenced, that I Will Teach You to Be Rich, or I Will, whatever that title is, by Ramit.
I Will Teach You to Be Rich. Yeah.
Yeah. He had the opposite. His dad forced him to put his money into a Roth or something when he was 15, or had saved money doing some job. And he ended up buying one stock that did really, really well. And I was like,
well, I think everybody believes they can find that one.
Yeah, that one stock.
Mm-hmm.
I come from a family that's lost their retirements a few times from that strategy. So,
any other points of discussion?
Sorry. Thank you, Dr. Napenas.
No, thank you. Thanks for. If not, I'm going to save this chat, make sure I have everybody's email. But hey, I'll get, I thought this was going to be the last one of the series. This could easily be 2 talks. So I appreciate you staying long. For those that did, we'll get the recordings up shortly. We'll get the handouts shortly also. Thanks to everybody who participated. I will see you next month. We'll get the information out to that. So, all right. Have a good night, everyone.
Thank you, Joe.
Good night.
Thank you.